After working with hundreds of high net worth individuals in their businesses, I noticed something that most people will never see. Paying less tax isn't about loopholes. It isn't about hiding money, and it's definitely not about one magic trick. Tax is a game of chess. The rules are written in advance, the incentives are public, and the people who constantly pay less tax aren't cheating. They're just playing the game correctly. Most people never get past the random moves. They react, they guess, they copy things that they don't understand. High earners don't do that. They move in sequence. Each move builds leverage for the next, and the impact compounds as they go. So let me walk you through the first 7 moves, starting small, stacking intentionally, and ending where the tax code creates the most leverage. Most people think taxes are about deductions. They're wrong. Taxes start with how income shows up on the return. W-2 income is the most expensive income in America. You pay ordinary income tax, payroll tax, and you get the fewest options. Business is different. When structured correctly, it lets you decide how much is wage, how much avoids payroll tax, how income flows into the return. That's why entity structure matters. For the right businesses, an S-corp election alone can reduce self-employment tax exposure. Average savings, $8,000 to $15,000 per year, sometimes more. This isn't about gaming the salary. It's about aligning income with how the code's already treated. Once income is flowing the right way, it stops being about income itself and it becomes about exposure. And one of the cleanest way to reduce exposure is income shifting. Not hiding income, not avoiding income, redirecting where it's taxed. One of the oldest and most explicit example in the tax code is hiring your children into your legitimate business. When done correctly, wages are deductible. Income shifts from higher brackets to low or zero brackets. Payroll taxes may be avoided depending on the structure. This isn't aggressive, it's explicitly allowed. The rules are simple: real work, reasonable pay, proper payroll, real documentation, and the average savings is about $5,000 to $15,000 per child per year. Once income is structured correctly and exposure is reduced at the top, the next question becomes, what expenses can you legally move from personal to business? The next move is turning your home into a tax asset. This is where most people either do nothing or they do it wrong. The home office isn't about squeezing pennies. It's about changing the characteristics of expenses. When done correctly, it converts a portion of your house, utilities, internet, and maintenance into legitimate business deduction. There are multiple compliant methods: square footage, safe harbor, and room-based allocation. And when structured properly, it straightens everything else you do. The average savings on this is about $3,000 to $10,000 per year, often more depending on where you live. At this stage, the savings are steady but controlled. The next move aren't about small conversions. They're about how timing and structure amplifies deductions. Next move, we're going to use the code structural incentive. Some of the most powerful deductions aren't flashy. They're structured. The Augusta rules allow homeowners to rent their home to their businesses for up to 14 days per year. The results? Deductible to the business, tax-free to the owner. When you layer that with timing strategies, it accelerates expenses. It defers income, stacking deductions into peak years. The average savings, about $5,000 to $20,000 per year, depending on execution. This is where planning starts to feel intentional. But the real leverage comes next, when business activity starts to move. Business travel is one of the most distorted topics online. The rules are clear: real business purpose, ordinary and necessary, primary business time, airtight documentations. When those boxes are checked, travel becomes deductible. Flights, hotel, transportation, meals. Average savings here is about $3,000 to $15,000 per year, depending on how frequent you're traveling for business, of course. High earners don't force vacations into deductions. They build business into trips that already make sense. Once movement increases, the next question becomes unavoidable. The vehicle deduction is one of the most abused strategies because people start with the car instead of the structure. When done correctly, business vehicles can accelerate depreciation, convert operating costs into deductions, reduce taxable income materially. But remember, structure matters. Business use percentage, depreciation method, timing, financing. This isn't buy a G-Wagon and write it off. That's how audits happen. Average savings, $5,000 to $25,000 a year, depending on usage. At this point, most people think they reached the ceiling, but the truth is they haven't, because the tax code's biggest lever was never the vehicle or travel. It was ownership. Real estate is powerful for one reason: depreciation lets you create paper loss without losing cash. Short-term rentals, STRs, when structured correctly, can qualify as an active business, generate losses that offset W-2 income or business income, front-load depreciation through cost segregation. This is not automatic. It requires material participation, average state compliance, and real documentation. But when done correctly, it's the most powerful move in the tax code. Average first year savings, 20,000 to 100,000 plus, depending on property value and income. That's why high earners keep using real estate, not for appreciation, for control. Most people chase tactics, high earners play sequence. Each move reduces exposure, reinforces the next, compounds over time. That's why two people with the same income can have radically different tax bills. Paying less tax isn't about being aggressive, it's about being intentional. The tax code rewards ownership, structure, planning, documentation. If you play these 7 moves correctly, you don't just save this year, you control taxes going forward. In the next video, I'll break down one move in detail and show exactly where people mess it up, even when they think they're doing it right.